Hi, my name is Eugene Hoover. Let's get started. As you approach retirement, your investment portfolio likely needs a serious makeover. You've spent decades sacrificing for the older you. When markets are going up, risk can feel like a distant memory. But let's be real. Low interest rates, accommodative monetary policy, and government handouts have led to a blockbuster decade in stocks. Low volatility and steady gains have turned every portfolio manager into a rock star. With retirement stretching 20 or even 30 years, your portfolio can't afford to gamble on good times forever, especially with the monetary landscape changing significantly for the first time in over a decade. Your portfolio should be prepared for all weather: booms, busts, deflation spikes, and everything in between. A good portfolio as you approach and enjoy retirement needs to have limited downside risk. The last 15 years has told us that holding 20 plus different stocks in a portfolio is diversified. A longer look at history tells us this is not true. True diversification and the path to achieving a high Sharpe and Sortino ratio, which is our goal here at the firm every year, requires investment in other asset classes. If you are unfamiliar with these ratios, they essentially compare the amount of risk taken to achieve a specified return. These asset classes can include things like precious metals and fixed income. The goal is to engineer a smooth ride through retirement. While this obviously helps keep your stress level down, mathematically, it helps avoid sequence of returns risk. The math of taking distributions from your account as the market moves up and down is very different from the math when you are contributing. The shift to de-risking and funding intentional exposure of paramount importance when you are getting close to retirement. Markets don't care about your timeline. A big downturn right when you start withdrawing could wipe out years of needed assets. That's sequence of returns risk in action. We also need to talk about your withdrawal rate, which is the industry's standard advice for retirees. Every few years, there is a study that evaluates what percentage of your portfolio you can distribute per year and not run out of money. What a bunch of malarkey. Retirement is not a flat line. It's phased with different needs at each stage. Think of it in quadrants: your go-go years, which is your early retirement, active travel, and experiences. Your slow go, which is your mid-retirement, you're scaling back as you slow down, and then of course your no-go years, which are your later years focused on health and essentials. And last but not least, legacy, passing on wealth essentially. If you'd like to learn more about these quadrants, check out our free retirement guide in the description. But in short, your retirement expenses are not linear, and neither are your goals, which brings up another great point. The investments used for short-term goals and expenses should not look like the investments for long-term goals and expenses. Letting a bad year in the stock market derail your once-in-a-lifetime vacation is stupid. And you can't see it, but I intentionally misspelled stupid when I wrote this. When you're taking a look at your broader portfolio, it is a great idea to look at your stable income versus your income at risk. Also make sure to calculate, as explained at length in our retirement guide, your minimum dignity floor. This video is already too long, so I won't go in depth on tax strategies, but keep in mind that if you have multiple account types, a distribution plan, asset placement, and conversions can potentially avoid a lot of taxation. Have a good one.